Today we focus on East Africa's technology and investment landscape. Safaricom shares have surged over 25% in recent months, attracting significant investor interest and reshaping market dynamics. What's behind this rise? Safaricom's strategic shift towards becoming Africa's leading technology company, particularly through its impactful expansion into Ethiopia, is key. We'll explore how this move has boosted investor confidence and elevated the company's status. From trends affecting major businesses to practical financial strategies, Mint is here to empower you. Stay with us. My name is Lydia Nyawera. Also, today on Mint, the rising cost of fuel continues to be a pain for consumers. Milk your profits, uncovering the hidden wealth of a well-managed dairy farm. Ink to income, Isaac Yenya turns passion into profit. This week, we are cutting through the noise to provide you with insights that matter to your finances. Have you noticed the surge in Safaricom's share price? It has been on an impressive upward trend, largely due to their bold expansion into Ethiopia, which solidifies their position as a leading technology company in Africa. We will break down what this means for investors and the broader market.
Welcome to Money Moves, your go-to for understanding what's moving the economy. Today, we're putting one of Kenya's biggest players under the microscope, Safaricom. If you're an investor or even just curious about the economy, you've likely seen Safaricom stock making headlines this year. So what's been happening? Let's break it down. Looking at the year so far, it's been a dynamic ride for Safaricom on the NSE. After some fluctuations, we've seen a noticeable upward trend. In fact, year to date, the Safaricom stock has shown a 54.36% increase, with a more recent monthly rise of 10.63% and a weekly jump of 3.31%. That's a significant bounce. So, what's behind this bullish momentum? Several key factors have been fueling investor confidence. Safaricom's recently concluded 5-year strategy has been a success, leading to strong financial results. The company has seen impressive customer growth across all segments, with improvements in key performance indicators. Investors are clearly reacting positively to this solid operational delivery. The approval and detailed presentation of Safaricom's new 5-year strategy has also provided clarity and confidence. The company aims to become Africa's leading purpose-led technology company, focusing on more solutions-driven growth. This long-term vision has resonated with analysts and investors alike. A generally improving macroeconomic environment in both Kenya and Ethiopia has also played a role. We've seen inflation ease in Ethiopia and a period of stability in the Kenyan shilling, which is particularly attractive to foreign investors. Investors have shown a strong belief in Safaricom's management team to execute on their strategies and deliver on guided targets. The resilience of the Kenyan business, particularly in M-Pesa, connectivity, and fixed services, has also been highlighted. Even when the share price was lower, many analysts consistently viewed Safaricom's stock as undervalued, suggesting a significant upside potential. And let's not forget about dividends. Safaricom has continued to reward its shareholders. For the year ending March 31, 2025, the company announced a total dividend of 1 shilling 20 cents per share, comprising an interim dividend of 55 cents and a final dividend of 65 cents. This consistent dividend payout remains an attractive feature for many investors, especially in an environment where alternative investment yields like bonds and T-bills might be lower. The answer also lies largely in the promising developments from Safaricom's Ethiopian venture, which is quickly becoming a significant driver of growth. Just recently, Safaricom Ethiopia announced a major milestone: 10 million active customers on its network over the last 90 days. This isn't just a number. It signifies a rapid growing, loyal customer base, as customers active for 90 days are considered long-term users, not just temporary ones. To put this in perspective, it took Safaricom 8 years to reach 10 million customers in Kenya. Ethiopia has achieved this much faster, showcasing a remarkable adoption rate for the service. Initially, Safaricom Ethiopia thrived on providing excellent mobile data, thanks to the new state-of-the-art 4G infrastructure. However, as the customer base grows, so does the potential for more profitable on-net usage. That's when Safaricom customers call and text each other within the same network. This reduces costs for Safaricom, as they don't have to pay mobile termination rates to other providers like Ethiotel. Another exciting factor is a strong appetite for data in Ethiopia. Of the 10 million customers, 7.1 million are active mobile data users, with average consumption rising to 6.5 GB per month, a 53% increase from last year. This is significantly higher than Kenya's average of about 4 GB per customer. So, what's the outlook? Analysts are generally optimistic. Safaricom is forecast to grow earnings and revenue significantly in the coming years. While past performance is not indicative of future results, the current trajectory and strategic initiatives suggest continued focus on growth and shareholder value. The stock did experience a correction phase at some point, which analysts often view as a healthy part of market dynamics and a potential opportunity for strategic investment. Safaricom remains a dominant force in the Kenyan market and is making significant strides in its regional expansion. Its stock performance this year reflects a renewed investor confidence in its strategic direction and operational execution.
Today we are discussing a topic that has everyone talking: the recent increase in fuel prices, which has added an extra 9 shillings per litre. Why do fuel costs continue to rise? Why are we paying more than our neighbors in Uganda or South Africa? Most importantly, will it ever improve? I will explain the real reasons behind these numbers. Following the recent review by the Energy and Petroleum Regulatory Authority, the cost of fuel in Kenya is now an everyday conversation for most. Whether you're driving or taking a taxi, the struggle is shared. So, what's the reason for the higher fuel cost in Kenya? Yes, you guessed it right: taxes. VAT is the most well-known, but there are also at least 7 other taxes levied on fuel in Kenya. The result? 40% of what you pay for at the pump is just tax. Simply put, out of every 10 shillings you pay for a litre of fuel, 4 shillings goes to taxes. Let's compare that with a few other countries. In America, the highest fuel tax is 14%, while in South Africa, it's at 30%. How exactly did we get here? Buckle up and let's go for a ride. Kenya introduced VAT in 1990 at a rate of 17% to replace the 3% sales tax. Back then, Kenya was broke, and the IMF lent it money on condition, among them, higher taxes. What does this mean? You said VAT was introduced in 1990. It's a little confusing. The pain at the pump was then postponed twice. In 2018, the rains finally caught up with us, but a compromise saw VAT capped at 8%, not 16%. Enter the Finance Act 2023, and out goes the compromise. And since then, the taxes have kept the cost of fuel up. But that is not all that is keeping the prices of fuel up currently. 3 other things have happened in the last review. First, the government has denied consumers relief at the pump for the 2nd consecutive month after it opted not to tap the fuel subsidy to prevent prices from shooting up. The subsidy has at times prevented pump prices from rising by upwards of 9 shillings per litre of diesel, 7 shillings per litre of petrol, and 8 shillings per litre of kerosene. The landing cost of petrol in May was 76.83 shillings, while this rose to 81.88 shillings in June. For diesel, the landing cost in May was 75.43 shillings, while in June, the price was 80.22 shillings. For kerosene, the cost was 73.80 in May and 79.42 in June. The third factor is that the margins for oil marketing companies have also been increased in the latest review by EPRA. The margins on petrol have been increased to 17.39 shillings per litre from 15.24 shillings the previous month, while those for diesel have gone up to 17.32 shillings per litre from 15.16 shillings. For kerosene, the OMC margins have risen to 17.24 shillings per litre from 15.09 shillings in the June 15 to July 14 cycle. So here's the thing. High fuel costs drive costs of everyday commodities up, and this gets the voters hungry and angry. That's why governments are always trying to find ways to keep the fuel costs down. But when the coffers run low, the government fails to subsidize, as has happened in the last two cycles. So many interventions, many quick fixes, but what is never reviewed downwards is the tax. So as long as the taxes remain a huge component of the price markup, we will be here for a very, very long time. Now you know that there are at least 8 taxes levied on fuel in Kenya, and out of every 10 shillings you pay for a litre of fuel, 4 shillings go towards taxes. Let's take a short break. We'll be right back. Milk your profits, uncovering the hidden wealth of a well-managed dairy farm.
Earn it, spend it.